we've had our ups and downs in our funds too.
For sure.
And everyone says, we're long-term oriented, but if you're a value investor, you really have to be. It's true that things are accelerating everywhere in life, and including in the markets. And a lot of that's because of algorithmic trading, which you mentioned earlier, which I think is about 75-80% of market volume now. There's a saying that I think it was Warren Buffett said that successful people say no often, and really successful people say no almost all the time. If you're getting really excited, you have a hunch, those are feelings. Feelings can be really fallible. I would say just at least do a cursory check. Yes, good due diligence could take 2 to 3 months. But you could look at the balance sheet and the income statement and figure out, like how much margin of safety do you have, or negative margin of safety do you have at the current price? And then you could just look at some quick quarterlies, listen to some quick conference calls, let's say an hour or two of due diligence. You don't have to jump right in. And then you'll have a sense of, is it safe? And in terms of the actual math behind it, like you gave the example of NVIDIA. Let's say it's going to go up 2,000% in the next 10 years or something, right? And so the price today is 5 and it goes to 7. You're like, oh my gosh, it's gone up 40%. But like if it's going to go to like 200, it's not even material, right? So if you're really long-term in your thinking, that what seems like large permutations in price in the near term are not actually large.
Right.
That's a mathematically true statement. So I think the only way to make that work, if that was Stanley Druckenmiller, is to always have, by definition, a short-term view. If your view is really long-term, even if it takes you 2 or 3 months to do your due diligence, but you're saying, I'm probably going to own this for 10 years, it's paying me a dividend, whatever, and it's going to compound like crazy and it's going to go up like an NVIDIA, I would just say do the due diligence first. It's okay to miss a lot of opportunities. It really is. I think it was Warren Buffett said, it's better to get rich slow than to get rich fast. I think the desire to get rich fast is where so many mistakes are made.
Absolutely.
But that having been said, there is also not only things moving faster now, but there's incredible volatility in markets now. It seems to me it's much greater. I'm sure there's probably studies on this than it was, say, 15 years ago. You're seeing sometimes really great companies collapse really suddenly, like 25, 30%, 40%. And it's just unbelievable, the volatility that would have been unthinkable.
Well, look at Oracle, just whatever it was 2 weeks ago.
40% in a day, right?
Crazy.
And Larry Ellison, I think, passed Elon Musk at one point. If something like that's happening, you know the company pretty well, or you can quickly look at the balance sheet, like, okay, wait a second here. This is like, you look at the earnings history, like for 15, 20 years, they've had consistent earnings. Consistent earnings are very important. Look at their margins. Okay, they've got great margins, software margins. I'm not talking about Oracle in this case, but let's give an example of another company like Adobe, for example, which is quite unpopular right now. It's like the anti-Oracle. And you can analyze what the company is, and you think like it falls off a cliff one day, like that you should probably act on quickly, even if you can only get in 30 minutes of due diligence. As long as you know you're not buying a speculative piece of junk, like an IPO or a pharmaceutical company that's, has all of its $10 billion market cap, hinging on one FDA approval or something like that. And you're like, okay, this is coming really long, consistent earnings. And like, even the numbers aren't bad, but the market's overreacting. The algorithms are probably driving this. Then, like, I would say, yeah, if you know what you're doing, even if it's only 30 minutes to do this, you can act quickly. But it has to be, again, with the idea that you're buying an A+ company, A+ management team, long history of consistent earnings and above average margins. There's not that much risk in that, I don't think, especially if the market's just clearly making a pricing error. You should move quickly on that.
If we're talking about broadly on a sector basis, do you see any kind of unloved sectors right now that you like, or are you specifically on a name-by-name basis?
Certainly, you could do both. You could say, like earlier this year, retail was destroyed with the tariffs. And we had like 3 appearances. You mentioned David Lynn earlier. We had 3 appearances on David Lynn where we laid out 7 or 8 names and said we're buying these aggressively. And they were like Kohl's and Walgreens and Nike and a bunch of other names. They all went on to outperform pretty dramatically. I think Kohl's went up 200% after we said we were buying it. Walgreens went up substantially as well. So you could say, well, there's a whole sector that's beat up, but not each issue within that sector will be equally good. So you could just do a comparison and say which one has the best margins, which one has, let's say, the highest enterprise value to EBITDA ratio. That's a great metric we like to look at. Owners' earnings per share is really another good one to look at. What's the margins? So let's say the whole sector is beat up. You're like, I'm a value investor. We're going to go shopping here. But let's try to find the best ones, because you don't want to diversify just for the sake of diversity's sake. You want to ideally put capital behind the ones with demonstrably the best margin of safety and that are most likely to get better than average returns.
Let's face it, one of the biggest frustrations investors have is taxes. You make the right call on that stock or explosive crypto trade, and then boom, half the gains are taxed. You took the risk and won, but the government takes their share of your gains. That's why I'm excited to introduce our sponsor of the pod today, iTrustCapital, the #1 crypto IRA platform in America. They've built a self-directed IRA platform where you can actually buy and sell crypto, gold, and silver inside a tax-advantaged IRA. Of course, you probably know trades inside an IRA are not taxable events under IRS rules. And I think the best part about iTrustCapital is they use the same institutional grade custody for crypto that BlackRock relies on. That is peace of mind. And they do it with no monthly fees, just a simple 1% transaction fee. I've spoken with the team and I like these guys. Real US-based customer service, security, and real tax advantages. And while I personally hold exposure to Bitcoin, gold, and silver through ETFs and mining stocks in my own retirement account here in Canada, iTrustCapital gives US investors the ability to hold the actual assets directly in an IRA. You can fund an account with a cash contribution, transfer an existing IRA, or even roll over an old 401k or employer plan to take more control of your future. So if you're looking to protect and grow your retirement with crypto, gold, or silver, check out our custom link in the description below and be sure to use promo code Pinnacle8 to claim your $100 funding bonus when signing up and funding a new IRA plan with at least $1,000. As always, all investments carry risk, and this isn't investment advice. Now, let's get back to the pod.
So again, you're going to have to get involved in accounting. I think it's security now is probably unpopular because it involves reading accounting, financial statements, which involves accounting, which not a lot of people like, but you got to do it. You just have to, because otherwise you don't really know what you're buying. So, but once you get good at it, it's easy. Like anything else. Like you were asking me how much time, 2 or 3 months to do diligence. I was like, I don't think I would spend 2 or 3 months on due diligence on anything anymore, because once you've done something for thousands of hours, it's just like second nature, Aaron?
Right.
And the second thing I would just say is that if you're looking at a balance sheet where you're like the Kohl's investment, for example, you can go back and watch that David Lynn report. We've got some great articles on our Substack. We have a great Substack subscription you can subscribe to where we really get into the balance sheet and we get into our price value dislocation, explain where the margin of safety is. We're saying like Kohl's trading for 24 cents on the dollar. Like, are we wrong? Maybe it's not $1, maybe it's 80 cents, but it's not 24 cents. So the thinking for the value investor is the inversion of the speculator. He says to himself, or her says to herself, whatever, I don't know what the price is going to be tomorrow or next week. I don't know population growth or collapse is going to be next month or next year. But I do know that I have such a magnificent margin of safety here that I can even afford to be wrong and still be covered. So whatever happens with the population, it's probably not going to happen in the next 6 months or even the next year, even in 5 years. And in that time, it might very well reverse, frankly, Aaron. So I would say get into what can be known and avoid what cannot be known. Macro issues tend to be heavily weighted on the speculative side.
Yeah.
The point is, you can know a balance sheet. You can know a statement of cash flow. You can know margins. There's things you can know, and there's things you can't. So why make it so hard on yourself? Like, you don't get extra points for difficulty. This isn't Olympic diving, like just take the easy ones, take the soft pitches, and go with those ones. The other one, if it gets difficult or complex, you're like, not sure. You're like, well, I'll just move on.